And we are continuing with our coverage from the LBMA in Montreal. Joining me now is Bart Melek of TD Securities. Bart, thank you so much for being with us tonight.
It's a pleasure to be here.
Bart, we speak so much about gold, but I'd like to talk to you a little bit about silver. What factors are weighing on the metal right now?
Well, right now I think the fundamental concern is industrial demand. Of course, as we all have seen, prospects for the global economy are not exactly effervescent. We're potentially faced with a material slowdown in the United States and recessionary conditions in Europe. Well, it's maybe not the case, but certainly the fear is out there. And the concern is that with silver being primarily driven by industrial demand, we could not have the expected deficits down the road, but in fact we could have looser markets. And for that reason, in my view, silver hasn't been performing as well as some would have expected it.
Right, because what I hear is if gold were to hit that magic $2,000 mark, silver could easily reach $50. Do you think we shouldn't be thinking along those lines then?
Well, certainly that is a possibility, but it is not our call. Our view is that silver will move up, but it will likely lag gold somewhat. And the reason being is that gold, for the most part, is a monetary unit, a hedge against potential inflation, a hedge against political instability, and silver is still very much used in industrial demand, and as a result, that will weigh it down, and it usually behaves halfway between gold and base metals. So it is precious, it is quasi-money, but it's not quite gold.
Okay, so if we do talk about gold quickly now, what are your thoughts here?
Well, we think that the gold should move past the $2,000 mark into 2012. Some of the factors driving it, in our view, are, I think, even easier monetary policy coming out of the United States. This Tuesday we'll likely have some sort of indication if the Federal Reserve is thinking of performing their variant of Operation Twist, where they buy a longer end of the yield curve, forcing yields lower, and gold has been responding very well to lower yield curves, especially on the 10-year government bond. And with that, one would think that gold should pick up as the risk environment is risk off, and we use gold as a hedge. And in fact, with yields for longer dated bonds falling, we're seeing real returns drop on those fixed income instruments, and that essentially means that the opportunity cost for holding gold is declining, and that usually spurs physical demand and investor demand.
What do you make of the corrections we've been seeing in gold? Sometimes we've seen a drop as far as $100. Is that cause for panic?
No, it's not cause for panic. I think a lot what we've seen in the recent week or so are liquidity-seeking activities by major banks. Some of the European entities were having difficulty of raising funds on the short end of the curve, and certainly had difficulty further out. And asset managers as well were forced to make margin calls, and they often sell asset classes that are liquid, and gold happens to be very liquid. So I don't think this is a fundamental macro event where gold is not seen favorably. I think this is just market dynamics where people are looking for liquidity and moving into cash. But I think that is a temporary phenomenon.
Bart, final message for investors out there.
Well, in our view, gold should move past $2,000 into 2012, and it is a good way to ensure your portfolio. I like to call it, gold as portfolio insurance.
Bart, thanks so much for your thoughts.
It was my pleasure. Thank you.
And thank you for watching. You can stay tuned to Kitco.com for more coverage from the LBMA in Montreal. For Kitco News, I'm Daniela Cambone.